The US stock market managed to end last Friday's session on a firm footing, with three major US stock indices recording all-time closing record highs, which is the small cap Russell 2000, the S&P 500, as well as the Dow Jones Industrial Average. The mega cap Nasdaq 100 continues to lag behind as it's still trading around 1.6% away from its fresh all-time high based on last Friday closing price action. The US dollar managed to find resistance post non-farm payroll data release, and as well as the University of Michigan sentiment survey for the month of January, despite the fact that the Fed rate cutbacks has been pushed forward down the calendar to April this year. Oil price continues to rally in today's Asia session, bridging slightly above the $59 per barrel for the West Texas crude oil due to rising geopolitical risk tension in the Middle East surrounding the revolution that could potentially take place in Iran. And due to this rising geopolitical risk premium, gold XAU/USD managed to breach above its fresh all-time high that was seen in late December last year, which is at the $4,550 per barrel as we are speaking in today's Asia session. Very good morning to all and welcome to a brand new trading week. I'm Kelvin here. Today will be the 12th of January 2026. So before we kickstart the gist of the daily dose, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so here we go. So let's have a quick look at what has taken shape on last Friday and as well as in today's early Asia session before we kickstart the intraday technical outlook on all the broad-based cross-asset classes. So for last Friday, let me touch on the key data, which is the US non-farm payroll data, as well as the University of Michigan preliminary sentiment data for the month of January. So let me expand my screen. Okay, give me a couple of seconds. Yes. So this is non-farm payroll data. So I would say that it's more like a mixed bag of data. Why? The headline non-farm payroll data came down below expectation, so it's rather a soft number. So market is expecting 60K jobs added for the month of December, but it only came in at 50K and also below 56K that was printed in the month of November, and this 56K was revised downwards from the initial estimate of 64K. So based on the headline number, the job market in the US still remains lackluster, and what's kind of a relieving was the unemployment rate. So the unemployment rate managed to inch down slightly lower by 1 basis point. Previously, it was at 4.5%. It inched down to 4.4%, and it was slightly below expectation of 4.5%. So what you could see over here is a slight downward tick in unemployment rate, but however, the non-farm payroll data showing there are lesser jobs being added for the month of December. So overall, it's a mixed reading. And after that, at 11 p.m. Singapore time, you have the University of Michigan sentiment data, which is also a key data as well. Why? Because consumer sentiment is a leading tier 1 economic indicator that potentially could drive retail sales spending in the US. And we know that retail sales spending is part of the services sector in the US economy, which contribute close to 3/4 of US GDP growth. So what you could see over here is that consumer sentiment managed to inch higher at 54.0, above 52.9 that was printed in the month of December, and slightly above expectation of 53.5. So the net overall impact over here is that the US Federal Reserve, after cutting interest rate 3 times for 2025, in the next upcoming meeting, which is the end of this month, they could actually wait and see and assess for further economic relevant data before they potentially continues to cut rates further. So if you look at the Fed Funds futures market as being so-called calculated by the CME Fed Watch tool, so right now, we see a very high chance of almost 100% chance, I would say 95% chance, that the Fed Funds futures trader is expect the Fed to stamp at 3.5% to 3.75%. So that was being, okay, let me give me it now. Let me reduce it. So that was being jump up from a week ago at 83%. And also we know that prior to the release of the non-farm payroll data, the unemployment rate and the University of Michigan Consumer Sentiment preliminary figure for January, the figure hover around 85% chance to 6% chance. So after the release of such mixed bag of reading, that rate cut bets has been reduced dramatically, and right now Fed funds futures traders are expecting almost 100% chance the Fed will stand pat on the 28th of January to maintain the Fed funds rate at 3.5% to 3.75%. And what's interesting over here is that based on the aggregated tab, where we are able to see a slew of rate cut bets or the probability of whether the Fed will cut, hold, or hike, the next upcoming rate cut bet, previously we do see a high chance coming in on the 29th of April, which I shared with you guys earlier on, about 56 to 60% chance, but that has also been reduced to below 50% chance right now to 48.9. So the potential fourth interest rate cut will only come in much later. So it's being pushed down the calendar right now to 17th of March 2026 at about 100% chance, 99% chance that the Fed will introduce the fourth cut on the 17th of June 2026 instead right now, to bring the Fed funds rate now to 3.25% to 3.5%. But however, markets still continue to see at least 2 interest rate cuts before 2026 end, because if you look at the last meeting, the 9th of December 2026, 93% chance the market is expecting the Fed to end the Fed funds rate at 3% to 3.25%, with the potential fifth cut coming in either the 16th of September meeting, which is at 72% chance, or the October meeting, the 28th of October meeting at 85% chance. So the net result over here is that we still continues to see potentially that the Fed will still continue its interest rate cut cycle. It's only that the next cut, which is the fourth cut, is being pushed down the calendar. And also that allows the US dollar to continues to trade in a rather sideways fashion, where we managed to see some resistance that's being formed on last Friday, and so in today's Asia session, where the dollar starts to trade downwards, all right, the downbeat over here. So this is the 5-day rolling performance as of 12th of January, as we are speaking right now, 11:11 a.m. Singapore time. And if you look at the US dollar index, we do mention that there's this key resistance level to look out for at the 98.86 and 99.23, where price action managed to shape a intraday bearish reaction candlestick right now on the US dollar chart, which is the US dollar index daily chart, and right exactly at the upper limit of this key intermediate resistance level, which is also the 50-day moving average as well, that confirms the upper limit at 99.23. So what I'm trying to actually express for you guys over here is that the rebound that's being seen on 24th of December during the Christmas session break, all the way up to last Friday, the first full week trading week in the month of January, the US dollar strength has now started to form some form of resistance at the 99.22, and potentially right now we may see another round of US dollar weakness, at least on a shorter term basis over here, right? So that's for the FX market. And like I mentioned earlier on, is that the US stock market continues to be in a rather upbeat fashion over here. So all the 4 major indices close in the green. So I'd like to highlight is that the Dow Jones Industrial Average managed to surge to a fresh all-time high on Friday, all-time closing high, followed by the Russell 2000 and as well as the S&P 500 as well. So the one that is still lagging behind will be the mega cap technology centric stock, which is the NASDAQ 100, up by 1%. But if you look at the NASDAQ 100 cash index over here, it's still trading below their all-time high that was printed previously in the month of late October, 20 October at 26,182. So based on last Friday closing price, it's still rather positive. Why? Because price action starts to trade a series of higher low and is now reintegrate back above the 20-day and the 50-day moving average since the 5th of January. So what we could see over here is that we cannot have the NASDAQ 100 plunging downwards whereas the other three major indicators going to soar to fresh all-time high. So the theme for 2026, it will be that all four major US indices will try to trade in the upward trend, but in terms of the performance, the Nasdaq 100 will lag behind. That means there's a lack of, we call it, a bullish momentum, and more bullish momentum will be centered into the prior laggards, which is the industrial stocks, the financial stocks, as well as the small cap, and in some form of the consumer discretionary, as sector rotation starts to move away from that much more highly valued mega cap technology stock that has been centered on the AI team play. And this is a big if, is that the Fed needs to be continue in their interest rate cut cycle to maintain the liquidity inflow for the US financial system. Right, so that's for the US stock market. And also over in Asia, over here, we see the Nikkei 225 that is trading on Globex right now, CME, breaching into a fresh all-time high, breaking above its October high, despite the Nikkei 225 cash market is closed today because there's a Japanese holiday today. But the Nikkei 225 futures still continues to trade on the futures market due to this news flow stating that the Japan ruling coalition, one of the partner, Hirofumi Shishima, the leader of one of the partner of the current Japan ruling coalition, where the Japanese PM Takachi, which is the LDP party, give a kind of a quote to a local newspaper, a newspaper reporting that Takachi may call for a vote on it's a snap election of the lower house on February 18 or February 15, citing unidentified government officials. So the reason why she called for a vote is because due to her support ratings has held steadily at historical high levels. So given the fact that the previous election in Japan, the current LDP party and its coalition partner does not have a significant, we call it, sitting in the lower house. So due to this current high popularity ratings on the current Prime Minister Takachi, she may actually use her strong ratings to actually take advantage of it and call for a snap election, hoping for a increase in majority of her party and her college and her allies in the lower parliament house of Japan, and that potentially could allow her to push for her much more strong fiscal policy that she has been advocating for the Japanese economy, and that explains why the Japan 225, the Japan 225 CFD index, or the Nikkei 225 futures, is surging to a fresh all-time high right now as we are speaking in today's Asia session, which is up by 0.5% over here. And also due to this very strong showing in the US stock market, you also have a positive follow through in other Asia market as well, where the Hang Seng index is up by 0.64% as we are speaking right now, trading to a session high, coupled with the slightly downtick in the CSI 300 with 0.12%, a slight pullback, and the rest of the other Asia markets or Asia Pacific market continue to bask in the bullish limelight, where the ASX 200 Australia index up by 0.4%, and the STI is up by a whopping 0.6% as it try to retest its current all-time high level. All right, so overall, still kind of a risk-on environment in the Asia Pacific stock market and as well as the global stock market, despite rising geopolitical risk premium in the Middle East due to this Iran threat over here. So Iran threatened US and Israel as Iran protests enter the third week. So what we could see over the weekend is that the US president has been briefed on the range of options for military strikes in Iran, citing it for a potential regime change, where US did with Venezuela a week ago. And if Iran were to get attacked by US, very likely there could be a rising geopolitical risk premium in the Middle East, where Israel could take part as well. And that causes gold price and silver, gold to hit all-time high, and silver retesting its all-time high right now, okay, because of geopolitical risk premium. But what's interesting over here is that this geopolitical risk premium rising is not being reflected in the global stock market as we are speaking right now, because the Asia Pacific market is still trading in the bullish limelight. due to a positive follow through from the US stock market, and as well as the US dollar strength that is being seen last week managed to hit a resistance level. All right, so that is the two catalysts that is driving the risk on behavior, ignoring the geopolitical risk premium that is rising in the Middle East. All right, so that's cover the first segment of the daily dose. Let me touch on the second segment, which is the intraday technical outlook segment. All right, so let me expand my screen. Okay, so let us start with the US stock market first. All right, over here. So hopefully that everything is good in terms of the charts itself. Okay, let me expand my screen. Okay, give me 1 second. Okay, expand my screen. Okay, so let us start with the US market. US FX, the FX market, pardon me. Okay, starting with the euro dollar. So before we jump into the euro dollar daily chart, I want to share with you the chart of the hourly chart. Pardon me, I want to share with you the chart of the daily chart. Right. So what I could see over here is that the US dollar after exposed FOMC, it managed to find support at the 50-day moving average, and also very closely with this major ascending channel support drawn out from the low of 13th of January in this turquoise, because in this light green line over here. And if you look at the hourly time frame chart right now, the hourly RSI after testing the 50-day, the price action tested the 50-day moving average, which is our pivotal support at 116.40 thereabout, and it starts to shape a bullish divergence on the hourly RSI over here. So indicating that downside momentum that is being seen late last week from Tuesday all the way up to Friday has started to die off. So with that, we continue to maintain that bullish bias, advocating for that minor bullish reversal scenario to play out on the euro dollar, giving a bit of excess on last Friday low, which is 1660. So 11640/11616 short-term pivotal support level on the euro dollar for today. Maintain that bullish bias with two key resistance level to watch out for on the intraday basis: 117 figure, 117.28. A breakout above 117.28 will see a bullish exit from this minor descending trend line that has been in place since the Christmas break of 24th of December, and as well as the 20-day moving average, opening up scope for the next intermediate resistance to come in at 1765. Pardon me, 1765. Only a bearish breakdown below 11640/11660 will invalidate the minor bullish reversal scenario and see the corrective decline sequence extending further towards the 115.90 and the 115.50 next intermediate support level that confluence with the key 200-day moving average. So that's for the euro dollar. Next up will be the sterling pound. So the sterling pound managed to bounce off right exactly at the key 200-day moving average that also confluence with our pivotal support that we have on last Friday, short-term pivotal support, I mean 134 figure, 133.85. And right now the RSI also shaped a bullish divergence, indicating the easing off of that downside momentum that's been seen last week. So still maintaining that bullish bias for that minor bullish reversal on the sterling dollar in the first step. Two key resistance level to watch out for today: 134.50 followed by 134.90. So if we start to see a breakout above 134.45, pardon me, 134.45, we'll see a bullish exit from this descending trend line, minor descending trend line that has been in place since the Christmas break, the earlier 6th of July. Right over here, the 6th of January high, very clearly a breakout above the 20-day moving average will validate that, with the next intermediate resistance coming in at 134.90, then followed by the 133.50, 135.80 level. We also confluence very closely with the upper limit of this medium-term ascending channel from the low of 5th of November. Only a bearish breakdown below 133.85 will invalidate the minor bullish reversal scenario to see the extension of this corrective decline sequence extending further towards the next two support level in first step at 133.50 followed by 133.20, which is the minor swing low of 17th of December. So that's for the sterling dollar. All right, next up will be the Asia Pacific currency, starting with the Aussie dollar. So given the risk-on behavior being seen in the global stock market, the Aussie dollar also managed to trade higher, right exactly at our pivotal support level that we had on Friday, which confluenced with the rising 20-day moving average and as well as the lower limit of this minor ascending channel that had been in place since 24th of November 2025 low. And right now, we see a bullish divergence that's being flashed out on the hourly RSI, indicating that last week a minor corrective pullback is likely to have ended. So continues to hold a bullish bias for a minor bullish recovery in first minor bullish reversal scenario to continue to play out on the Aussie dollar over here, with the first resistance coming in at 67.20. A breakout above 67.20 will increase the odds of this bullish reversal scenario to retest at least the 11th of October 2024 swing high that managed to pause on 7th of January, which was last week over here at 67.60 in the first step. So two key recent levels to watch for today on an intraday basis: 67.20 followed by 67.60. Only a bearish breakdown below 66.60 will invalidate this minor bullish reversal scenario to see the extension of this corrective decline sequence, exposing 66.30 followed by the minor swing low of 18th of December, confluencing at the rising 50-day moving average at 65.90. So that's for the Aussie dollar. Quickly will be the dollar yen over here. So the dollar yen managed to squeeze up within our expectation and hit our resistance level at 57.88. And right now we start to see a bearish divergence on the hourly RSI. Right over here, there's a bearish divergence. So right now we'll be using today's Asia session high, which is at 58.20. That can't surpass on the US session high, ex-post FOMC, ex-post non-farm payroll data release, and as well as the University of Michigan data release over here. So 158.20 will be my short-term pivotal resistance level. Potentially there could be a dip taking shape. So first support level to watch will be this 57.28 / 57.57 figure level, the minor congestion, the former range stop that got taken out on the previous Friday over here, last Friday, all right, and now turns into a pullback support. And also this 57 figure level also confluence with the ascending channel support level that is being drawn from the low of 1st of October last year, all right. So that will be my first support level to watch. Only a breakdown below 57 figure level may expose a further pullback to retest the 20-day moving average, I think, as the next support level at 56.30 on the dollar yen. However, a bullish breakout above 58.20 will invalidate this minor pullback scenario and see the continuation of that bullish momentum to retest the medium-term pivotal resistance level at 58.80 over here. So what's 58.80? If you go to the daily chart, 58.80 is previously the minor swing low of the medium-term swing high, pardon me, of 10th of January, and as well as previously 11th of July 2024, where the dollar yen see a steep sell-off due to BOJ intervention under the instruction of the Japanese Ministry of Finance to sell the dollar and buy back the yen at that point in time, where then thereafter we have a psychological reaction on 10th of January, where it's also shaped that medium-term down move, and right now it's fast approaching this 158.80 again. So however, if we start to see a squeeze up above 158.80 on the intraday basis, then potentially we got to respect that bullish momentum, and it may see a test on the next resistance level at 59.75, which is a 1.236 Fibo extension taken from the low of 16th of December, 16th of this pardon me, yeah, 16th of December, and the 159.75 also confluence over here. If we go to the 4-hour chart with the congestion area of 24th of June. All right, so let's go back to the hourly time frame. So continue to watch this short-term pivotal support level, short-term pivotal resistance level. Again, going to watch this short-term pivotal resistance level at 158.20 for a potential minor pullback to retest 157.28, 157 figure level if 158.20 can't surpass to the upside. So that's for the dollar yen. All right. So that sum up the intraday technical outlook on all the 4 major US dollar pair. So let us touch with the major stock indices, starting with the Hong Kong 33, which represents the Hang Seng Index. So the Hong Kong 33 managed to shape a bounce right exactly at our pivotal support that we highlighted earlier, 25,915, 25,800 over here, and it's now testing our first resistance level at 26,440. All right, so if price action managed to have an hourly close above 26,440, then I will tighten my pivotal support level to 26,000, this 26,197 and 26,107. All right, this range here. So yes, I'm still keeping the pivotal support at 25,915, 25,800 level. Also confluence with the rising 20-day moving average, and as well as the lower limit of this minor ascending channel support as well from here. All right, over here. Then next resistance level to watch after 26,440 will be 26,656, followed by 26,920, very close to that minor swing high of 6th of January before this minor pullback take shape, and also the 1.382 Fibo extension of this ongoing bullish impulsive upmove sequence that has been in place since the low of 16th of December. Only a bearish breakdown below 25,800 level will invalidate the bullish impulsive scenario for the Hong Kong 33, representing the Hang Seng Index, to see a deeper chopper minor corrective pullback towards 25,545, which is the minor swing low of 29th of December and 2nd of January this year. A breakdown below 25,545 will critically expose the double bottom, the minor double bottom swing low of 25,110. Of course, this is the two minor double bottom bullish, and we see a bullish breakout on the 2nd of January, and price action did a bullish reversal right exactly at the former neckline of that double bottom bullish breakout. Now turns into a pullback resistance where previously managed to find support level as well. So that's for the Hong Kong 33. All right, next up will be the Japan 225, representing the Nikkei 225 over here. So what you could see is that the Japan 225 in today's Asia session going to trade very strongly, taking the cue of the Nikkei 225 futures trading over at Globex over here. So for the Japan 225 CFD index, given the fact that the hourly RSI is going to be in the overbought level, there's no clear divergence that's being seen. So what we could see is that I will have a very tight short-term pivotal support level for today, which is the breakout line of this former upper limit of this medium minor ascending channel got broken out on last Friday, now turns into a pullback support level. And if we do the Fibo retracement of this steep up move from the low of last Thursday all the way up to today's Asia session high, that also constitute the 23.6% Fibo retracement. So with a very tight short-term pivotal support for today, 53,370 continue to maintain that bullish bias on the Japan 225. Two key resistance level to watch out for will be 54,110, which is another fresh all-time high, which is the 0.764 Fibo extension of this ongoing minor bullish impulsive upmove sequence taken from the low of 18th of December. Above 54,110 will potentially seek out 54,565, which is the 0.318 Fibo extension of this much more minor fractal subset of this bullish impulsive upmove sequence taken from the low of 8th of January, which is last Thursday. Only a bearish breakdown below 53,370 that will invalidate the direct bullish bias scenario push up and start to see a minor corrective pullback to retest the former all-time high area over here that was made in 4th of November, and it got taken out on last Friday during the US session. That will be at 52,830, 52,644. So if price actions float down to 52,830, 52,644, I'll be still on the lookout for a bullish reversal candlestick pattern to flip my bias back to the bullish side of the story again, given that the medium term and the minor uptrend phase still continues to remain intact on the Japan 225 over here, which is the C, which is representing the Nikkei 225. Onward next will be the Germany 30 over here. So the Germany 30 continues to churn higher over here. So what we could see over here is that it goes to churn higher with a series of higher high and higher low, holding right above our pivotal first support level at 25,065. So what I'm going to do is that I will tighten the pivotal support level today to 25,065, given that it goes to trend higher in a series of higher high and higher low. Right, so let me push it up here. That will be 25,065. Right, 25,065. Okay, so this will trend higher. Save it. So this will be a normal support level, 24,860. All right, tidy it up. Okay, so for today, I will tighten my pivotal support on the Germany 30, representing the German DAX, to 25,065. Next resistance level to watch, no change, a FIBO extension level, which I highlighted on last Friday, 25,433. A breakout above it exposes the next FIBO extension level cluster, which is at 25,800 in this ongoing bullish impulsive up move. Only a bearish breakdown and an hourly close below 25,065 that would invalidate the direct push-up scenario and kickstart a minor corrective pullback, exposing the next two near-term support level at 24,860, 24,670. So if price actually floated down towards this zone here of 24,860 and 24,670, I'll be still on the lookout for a bullish reversal candlestick to still maintain my camp towards the bullish side of the story, given that the medium term and the minor uptrend phase still remains intact, at price action going to trade above the rising 50-day and the 20-day moving average over here. So that's for the Germany 30. Next up, major US stock indices, starting with the US Wall Street 30 that is representing the Dow Jones Industrial Average. So the US Wall Street 30 hit the first resistance level, which was the 7th of January minus swing high on last Friday at 49,606. And now in today's Asia session, there's a minor pullback to retest the first intermediate support at 49,250. So given that it can't have a clear breakout above 49,606, I do not want to tighten my pivotal support to 49,250 for today, for now, in the Asia session, as we are speaking at 11:35 a.m. Singapore time. So instead, I'll be using 48,870, 48,770. That will be my short-term pivotal support level for now, and maintain that bullish bias as it en route towards the next resistance level at 49,805, 49,840. And this week will also be a very pivotal week on the US Wall Street 30 CFD index that's representing the Dow Jones Industrial Average. Why? Because this week will kickstart the Q4 earnings season in the US, starting with the major US banks like JP Morgan, Wells Fargo, Citigroup, as well as key financials, BlackRock, Goldman Sachs, Morgan Stanley. Later, I'll share you guys what are the key dates to look out for. So when you kickstart tomorrow instead, then that could potentially influence the volatility of the US Wall Street 30. Why? Because all these banks have a heavy weightage in the US Wall Street 30, and the US Wall Street 30 has also a significant weightage towards the financial sector and very little lesser weightage on the technology sector. So hereby, the US Wall Street 30 this week could face a much more higher volatility environment as compared to the Dow Jones, as compared to the Nasdaq 100, pardon me, and the S&P 500. Only a bearish breakdown below 48,770 today will negate the, we call it a bullish tone, to see another round of minor corrective decline, exposing the next two support level at 48,480, followed by 48,100, slightly above the 47,870, which is my medium-term pivotal support level. So if price action float down towards 48,480, 48,100 level, I'll be still on the lookout for a bullish reversal candlestick as price action continues to trade above the rising 50-day moving average. So that's for the US Wall Street 30. Next up will be the S&P 500. So the S&P 500 did a fresh all-time high over here. There's a all-time intraday high before shipping a pullback in today's Asia session. So with that, I will still maintain that bullish bias with a first intermediate support level at 6,925. However, I don't want to tighten the pivotal support to 6,925 to be so tight unless we have an hourly close and a push up back above 6,969 again. All right, because there's a price break below 6,969 during the Asia session today as we are speaking at 11:30 a.m. Singapore time. So using the same pivotal support zone that we have on last Friday, 6,900, 6,880, we'll still maintain that bullish bias. Above 6,696, potentially seek out the next resistance level at 7,705, which is a FIBO extension level of 0.764. However, a bearish breakdown below 6,880 that would invalidate the bullish bias scenario on the SPX 500 for today to see a deeper minor corrective pullback, exposing the next near-term support level at 6,822, which confluence with the rising 50-day moving average as well. Over here. Oops. Okay. So that's for the SPX. Next up will be the NASDAQ 100. So NASDAQ 100 again squeeze up, test our first resistance level, which is the stubborn 8th of December to 12th of December 2000 range top, where it come broke previously and tested the first time, second time, third, fourth, fifth, okay, before shipping that pullback. So given this is still a stubborn minor range top or range resistance, I don't want to tighten my pivotal support to be so tight. So still maintain that 25,350. First support level to watch will be around the 20-day moving average, where price action managed to bounce, expose the release of that non-farm payroll data and the University of Michigan consumer sentiment preliminary data for January on last Friday. So still using 25,350 as my short-term pivotal support level. Price action to watch for today to maintain that bullish bias again will be this stubborn range top of 25,670, 25,830. So unless we have a clear breakout above 25,830, then potentially we'll see a minor bullish breakout for the NASDAQ 100 to en route towards the next resistance level at 26,107 before retesting the current all-time high at 26,290. So 26,107 is the minor swing high area of 31st of December and 3rd of November. Only a bearish breakdown below 25,350 that would jeopardize the NASDAQ 100 medium-term bullish bias, because it may involve into a choppy sideways range configuration again to expose the next near-term support level at 25,133 and 24,870 next. So that's for the NASDAQ 100. All right, and also that sum up all the intraday technical outlook on the broad-based stock indices. So let us touch on the commodities market right now, starting with gold XAU/USD. So gold XAU/USD, last Friday we still have a bearish bias for it to float down towards the medium-term pivotal support zone here at 43.3, 43.309. But however, price action continues to remain rather firm, trading above our first support level that we highlighted, 4,430, 4,403, and didn't even come close to it during the US session and starts to stage a breakout above our short-term pivotal resistance at 4,500. So what I could see over here is that the minor corrective push-down scenario has been invalidated, and based on last Friday price action and in today's Asia session, breaking above the former all-time high at 4,550 and 4,560 to see that 6% decline previously that was formed on 26th of December to 31st of December last year. This probability has been reduced very, very greatly after the strong showing on the price action of gold XAU/USD on last Friday and in today's Asia session. So with that, we got to respect the price action and flip our intraday bias now back to the bulls again, reducing the chance of that minor corrective pullback scenario that we envisaged in play since last week. So with that, I'll be using two key support level to watch will be the former all-time high area at 4,550/4,560. First support level to watch. Maximum for that minor pullback to take shape will be 4,500. So that was last week short-term pivotal resistance now turns into a short-term pivotal support level. So as long as any minor pullback managed to hold above 4,500 level short-term pivotal support, we will have a bullish bias for today. Two key resistance level to watch will defined by a Fibo extension cluster level, and as well as the close to the upper limit of this medium-term ascending channel that has been in place since 28th of October 2025 low, 4,645, followed by 4,684, 4,687 in the first step for gold XAU/USD. Only a bearish breakdown below 4,500 will invalidate today's bullish bias to see a deeper minor corrective pullback exposing to retest that 4,430 level and 4,403 level again, which is the rising 20-day moving average, and as well as last week minor swing low as well at 4,403. All right, so that's for gold XAU/USD. Next up will be the West Texas crude oil. So the West Texas crude oil has a very volatile session today. So today going to inch up higher at 0.84%. due to that rising geopolitical risk premium coming up from Middle East, triggered by the Iran crisis right now, where US and Israel may take a part of it right over here. So technical very mixed right now. Price action rallied, broke above that 59 13 17 short-term resistance that we have, and we whipsaw. And right now, fast approaching at our next resistance, which is the $60 per barrel, and the all-time high, the minor swing high of 5th of December last year. And elements has been mixed. Why? Because the hourly RSI starts to shape a bearish divergence. So with such mixed element over here, I will have a neutrality stance for today. So neutral between the $60 per barrel, which is the upper limit, and as well as the lower limit of my neutrality zone is 58.76. So 58.76 is now the former minor descending trendline resistance from 31st of July 2025, broken out on last Friday, now turns into a near-term key pullback support level. So only a bearish breakdown or a reintegration back below this medium-term descending trendline, which is at 58.76, that would invalidate a failure bullish breakout on last Friday, and see the price action reintegrate back into a choppy fashion again, back into the range, with the next support level coming in at 57.74 in first step, which is the 20-day moving average, followed by 57.15. However, a squeeze up above $60 per barrel may see a further up move towards 60.56, followed by 61.17, 61.35, which is the 1.382 Fibo extension taken from the low of 16th of December. All right, so that sum up the intraday technical outlook on West Texas Oil and all the key broad-based cross asset classes. So before we go, let's take a look at the economic calendar. What are the data to look out for today over here? So let me go to this week data over here. So today will be a very quiet session because today there's no key data to take note of, even during the US session as well. However, on Tuesday, during the early Asia session, before the start of our daily dose at 11 a.m., we have Australia consumer confidence data compiled by Westpac for the month of January at 7:30 a.m. Singapore time. So that could potentially influence the Aussie dollar, the Aussie crosses, and in some form the ASX 200 index. And talking about earnings, right, like I mentioned earlier at the start of the daily dose, US earnings session over here, kickstart this week. So the action will come in Tuesday, 13th of January, which is the key financials releasing their data. JP Morgan will be first of them, followed by Wednesday, January the 14th, Bank of America, Citigroup, and Wells Fargo. And also coming to Thursday, January the 15th, Morgan Stanley, Goldman Sachs, BlackRock. So all these key US financial, they will release their data before the start of the US session, which is now at 10:30 p.m. Singapore time. So usually they'll release between 6 p.m. and 7 p.m. Singapore time. That could potentially influence the movement of the CFD index at that point in time. All right, so that sum up today's daily dose of market insight. I will cover more about this when we continues the entire trading week. So have a great day ahead, and we shall speak again tomorrow. Thank you.